Penny stocks are often hyped as the fast track to massive profits, cheap shares that could turn you into a millionaire overnight. But behind the flashy headlines and social media hype lies a much riskier reality. We uncover the truth about penny stocks, the hidden dangers, pump and dump schemes, lack of transparency, and why so many investors lose money chasing quick gains. If you've ever been tempted to buy that next big thing under $1, you need to read this first. Today we will talk about the truth about penny stocks, what they don't tell you. So before we start, make sure to hit the like button and subscribe to my channel. Penny stocks have long been portrayed as the golden ticket to overnight wealth, the hidden gems that the big banks ignore, the secret investments that can multiply your money tenfold in a matter of weeks. You may have heard stories of people buying a stock at $0.10 and watching it rocket to $5, or how investors turned a few $100s into tens of thousands. But beneath the surface of these seductive tales lies a murky reality filled with extreme volatility, manipulation, hype-driven speculation, and regulatory gray zones. The truth is, penny stocks are not what most people think, and if you're considering investing in them, especially as a beginner, you need to know what you're really stepping into. Let's dive deep into what penny stocks truly are, how they work, why they carry outsized risks, and what's often left out of the glossy narratives on social media or penny stock guru channels. What are penny stocks, really? At their core, penny stocks refer to shares of small, low-cap companies that typically trade for less than $5 per share. While the name suggests these stocks cost mere pennies, they can range anywhere from a fraction of a cent to a few dollars. Most penny stocks are not traded on major exchanges like the NYSE or NASDAQ. Instead, they're listed on the OTC, over-the-counter markets, such as the OTC Bulletin Board, OTCBE, or Pink Sheets, which have less stringent listing requirements and far less transparency. Some penny stocks also exist on mainstream exchanges, particularly during the early stages of a company, or when a stock has fallen significantly in value. But in most cases, these companies are micro-cap or nano-cap, meaning their total market capitalization is under $300 million, often even under $50 million. The allure. Why people chase penny stocks. There are a few major reasons why penny stocks are so enticing, especially to new or low-capital investors. Low entry cost. With prices under $5, and sometimes under $0.01, people feel they can buy thousands or even tens of thousands of shares, dreaming of massive percentage gains. 10x, 20x, 50x potential. Since the stocks are cheap, a small move upward, say from $0.02 to $0.10, equals a 400% plus return. This kind of potential gain is hard to find in blue-chip stocks. Hidden gem narrative. There's a pervasive belief that many penny stocks represent undiscovered companies on the verge of explosive growth, much like Apple or Amazon in their infancy. Emotional marketing. YouTube videos, Reddit threads, Discord groups, and newsletters often pitch penny stocks using rags-to-riches stories, building FOMO, fear of missing out. Low barrier to entry. You don't need a large trading account or complex strategies to buy them. With commission-free brokers like Robinhood and Webull, anyone can get in. But what these sources often fail to tell you is that the very same characteristics that make penny stocks appealing also make them incredibly dangerous. The hidden dangers they don't tell you. 1. Extreme volatility. Penny stocks are highly volatile. A stock that gains 200% in a day can just as easily crash 90% the next day. These stocks are thinly traded, which means small buy or sell orders can cause massive price swings. One tweet, a misleading press release, or a short report can wipe out your position in minutes. 2. Lack of information and transparency. Most penny stock companies don't file regular reports with the SEC. They often have unaudited financials, little to no revenue, no clear business model, and questionable leadership. Due diligence is nearly impossible, and information, when available, may be outdated, exaggerated, or fabricated. 3. Pump and dump schemes. This is the dark underbelly of the penny stock world. Here's how it works. A group buys a large position in a low-volume penny stock. They pump the stock through fake news, email blasts, social media hype, or insider newsletters. Retail investors see the price moving and pile in. The original group then sells into the buying frenzy, the dump, crashing the stock and leaving late buyers with massive losses. These schemes are incredibly common in the penny stock arena and often go undetected for months or years. 4. Illiquidity. Many penny stocks have very low trading volume, meaning you can enter a position easily but struggle to exit. If you buy 10,000 shares of a $0.05 stock, you might find there's no one to sell to when it starts falling. That's how investors get trapped, holding worthless shares they can't offload. 5. Regulatory risk. Because many of these companies are in dubious financial shape or fail to meet reporting requirements, they risk being delisted or halted without warning. The SEC frequently halts penny stocks suspected of fraud or manipulation, leaving investors unable to trade them for weeks. Who's really making money from penny stocks? Spoiler, it's usually not the retail trader. The real winners in the penny stock game are promoters and newsletter operators who charge for exclusive picks, insiders and early investors who front-run retail hype, market makers who profit from the wide bid-ask spreads, YouTubers and influencers who earn ad revenue and affiliate fees off your clicks and FOMO. Meanwhile, everyday investors are left chasing volatility, often buying high and selling low, the classic trap. Realistic expectations versus market fantasy. Yes, there are rare success stories in penny stocks, usually involving meticulous research, timing, and a bit of luck. But these are the exception, not the rule. Most penny stocks go to zero or flatline. In fact, studies have shown that over 90% of penny stocks fail to produce any significant return over time, and the majority underperform the broader market significantly. Penny stocks are not inherently scams, but many of them operate in the gray area, and very few grow into serious companies. The narrative that you're investing in the next Tesla or the next Amazon is often a seductive fantasy with little basis in reality. Can you trade penny stocks safely? If you still want to trade penny stocks, the best approach is to treat them as high-risk trades, not investments. That means, use strict stop losses to manage downside. Avoid holding overnight unless you've done deep research. Never invest money you can afford to lose. Stick to stocks with actual volume and some verified financials. Ignore promotions and focus on priced action, not promises. Learn technical analysis. Most penny stock moves are driven by traders, not fundamentals. Even then, your success rate may be low, but at least you're entering with your eyes open. Safer alternatives to penny stocks. If you're seeking high-growth opportunities but want less risk, consider small-cap ETFs, EG IWM, Russell 2000. Crowdfunding platforms for vetted startups, Egg Republic, Seed Invest. Emerging market ECAS. Speculative crypto projects with actual utility. Low-float IPOs with institutional backing. These still carry risk but offer better transparency, regulation, and liquidity than typical OTC penny stocks. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment and click the button to subscribe.